Welcome to Keep What You Earn, your judgment and jargon-free zone for entrepreneurs of all levels. Get ready to learn how to scale your business, save money in taxes, and create a business that grows your wealth. If it feels like the financial side of business is like eating your vegetables, well, then think of this podcast as the ranch dressing to make the process a little more enjoyable. My name is Shannon Weinstein. I'm a CPA and business owner on a mission to simplify money and empower others through knowledge. I hope this episode inspires you to take action, but remember that the information we share is for educational purposes only and is not individual tax advice. Now that we got that out of the way, let's start the show. All right, so picture this. You get a random email or a phone call or even a message from a friend that says, "Hey, I have somebody who's interested in possibly buying your business. And let me tell you something really quick. This is how it's going to happen. Most likely, the way these deals tend to happen is they start organically through conversation. A lot of times, you're not really putting yourself out there as like, hey, I'm trying to sell my business. I'm trying to sell my business. I would say a lot of the times I've seen. Most of the exits I have been a part of or witnessed started from an organic conversation from either a peer or another company that does personal reach out, or even a business broker who is reaching out on behalf of somebody and just asking these questions. Have you thought about selling? And typically the business owner is approached or courted, right? At least from what I've seen. And what ends up happening is there's this like, oh, I didn't even think about that. And you're a little caught off guard. And because of that, this becomes especially challenging because if you decide you want to go through with this, or at least go through what is called like a letter of intent, right, which is an LOI, what happens is the letter of intent communicates typically the buyer's intent to buy your business. And what that does is it lays out all the terms and lays out all of the, the commitment and the confidentiality they promise to have, but they're going to ask you for a crap ton of information. And this is called the due diligence period. Now, during this due diligence period, or what people call pre due diligence sometimes, it's just the collection of information about your business that they can use to then determine their offer, determine whether or not they want to buy the business. Like, picture you're dating somebody and you have a chance to like go through their bedroom or their house, see how they live, see what you're getting yourself into. And this is a really, really important stage. So, what I wanted to do is share with you a couple of things that I think are important during this stage. So, if you do get approached by somebody, these are the things you want to have ready to go just in case. Think of it as like your fire escape plan or the things in your drawer that just lay out, hey, this is what we will do if, this happens. So, we'll have ready for them. And by the way, these are all things you should have probably in your business ready to go. And this is just your encouragement to make sure that's buttoned up and in place just in case this opportunity arises. So, number one, why does this actually matter? So, you really want to reduce surprises during a sales process. You really don't want to have any last minute, oh my God, I didn't know about this. Imagine you go to buy a home and then, like, the house inspection shows a major, major flaw and the whole deal blows up. You don't want that. You want your books to be clean. You want the business to be completely transparent. You would want to be super forthcoming with everything. And you want to build confidence between you, the buyer, any advisors or brokers in the process, and you want to clean up any red flags before they lower a valuation. So if there is something that is questionable or subjective or a little bit hazy, this is your opportunity to come forward and say proactively, hey, this is what you might see, and this is one thing you might have questions on, and here's my explanation for it. Now, your approach will vary based on, the exact terms and circumstances, but this is a good idea just to be especially forthcoming so that there's no lack of trust in this process. So, what will buyers actually scrutinize? So, number one is they're going to ask for 3 to 5 years of financial statements, but they need to be done in GAAP compliant, meaning this would get a little technical. Okay. GAAP is generally accepted accounting principles. So it's GAAP. And that tends to mean accrual accounting, which most people listening to this probably aren't following, which is okay, by the way. If you're making less than, I think it's 25 some odd million in revenue, then you would typically follow a cash basis accounting unless you're a C corporation. Most of those are under accrual accounting. So just kind of a rule of thumb here. So you're going to have to show your accrual financials. But the good news is there's a little toggle in QuickBooks that will show you that. And you may have to make a few adjustments and work with your bookkeeper to do that. So just keep in mind, as soon as this offer comes to the table, one of your first phone calls should be to your bookkeeper or accountant saying, hey, I'm going to need GAAP compliant financials at some point if this deal goes through, just to give them a heads up. You're going to want to also have policies completely documented on how you do your accounting. And I don't just mean like technically how to do accounting, but I mean, when you recognize certain things or the payment terms that your customers have and other aspects of how you do things that are a little bit of the rules of the road when it comes to your business. And you're going to want to have this is really crucial what we call EBITDA add backs. Fancy way of saying if you take your EBITDA, which is kind of like your net profit, and you want to be able to add back anything that is cash flow to you or that is kind of non recurring in nature so that you don't deflate the value. The goal of your financials when you're presenting them to a potential buyer is to showcase how much this business makes, to show how profitable it is. This is the opposite of the way that you want to present yourself in front of the IRS typically. Most people will want to present themselves in the IRS like they make no money and they're dirt poor, so they don't pay taxes. The hard part about that is if you then have to present financial statements and you have to present tax returns to a potential buyer, this could cast a shadow on your company and say, hey, I don't actually make much money. So the key thing here is being able to bridge the gap. This is one thing that we do exceptionally well as CFOs. This is one thing I pay attention to is being able to take the tax return and then be able to extract out the stuff that is purely strategic in nature, that is kind of cash flow to you. Things like your accountable plan reimbursements, things like your health insurance or your salary as the owner, and adding those back in to say, hey, if I wasn't making my salary or my distributions, the company would have this much money in it. Now, there would be somebody who would have to fill my role and they would typically make this much money. So if I make more than the market rate of a person that should be in my chair as CEO, then I'm going to say, hey, I think we should chop out a portion of my salary because in reality, this is what a CEO should cost you. Things like that. So you want to be adjusting your numbers a little bit based on what the reality is on an ongoing basis. So you want to agree on this with your potential buyer and you want to actually lay this out and say, well, my profit was X, but if you add back all of these other things that are not typical and are only existed because maybe something broke down this year and we had repairs and maintenance or whatever, we add back those things and you'll see it was actually quite profitable at its core. So this is why you really need to know your numbers. And if you are at your core very profitable, but just maybe not presenting as such because of one-time expenses or tax strategy.
Hey, Shannon here, and I have a quick favor to ask. If you're enjoying this podcast and enjoying this episode, please leave us a review on your podcast platform, whether that's Apple, Spotify, Amazon, any of them, and let us know if you're enjoying the show. One of your biggest takeaways, we would really, really appreciate it. Okay, back to the show.
The other thing you're going to need is have a corporate structure, all your corporate documents, and your cap table. If you don't know what a cap table is, this is what corporations use to measure out how many shares each investor or shareholder owns. This can also apply to S corporations or C corporations. And this will lay out for you the value and the contribution of each partner in terms of how much capital they put in. And this will lay out sort of what their, not necessarily their value is, but how much they own of the business. And that's going to be important. You're also going to want to have key contracts with vendors, customers, employment contracts, key employee handbooks and policies, all right, and any sort of IP ownership, filings, trademarks, all that stuff. You want to have that handy as almost like a booklet. And I recommend, if you want to get super tactical, I recommend having a binder that has all this stuff in it, all the what I call the permanent file. This is my auditor and me. We used to call it the perm file. And the perm file would have everything from board minutes to corporate documents, all the originals of everything, letters I got from the state agencies when I got my DOR filings, like having all of that, because you're going to get these letters. Typically, in your first few years as a founder, you're getting these letters personally to your mailing address or to your office. Please keep them and keep them in good storage and good condition because you may need them later. It's almost like remember the title of your vehicle and things like that. You want to have all that in a safe place in case you go to sell it. So you also want to have, certain metrics ready. So one thing that is typically asked for, it's in every deal I've ever seen, is at least the top 10 customers by revenue and what they spend per year. They want to know who the high value customers are. They also want to know if your whole customer base and your revenue base is made up of outliers. So here's an example. If you have a company that is making 10 million a year, but 5 million is concentrated in just a handful of customers, well, then do you really have a $10 million business, or do you have a $5 million business that got lucky with a couple of extra deals? So you really want to be clear about, hey, these are our customers. This is the spread of the revenue of where it's coming from. And then this is going to be assigned to the buyer, whether or not they have a viable business with a system and process that works. If this is truly a machine, because that's all we're trying to do here is figure out if your business is a machine or if your business is kind of, it got lucky, if you will, with certain customers. You want to have retention and churn metrics if these apply to you, and also any sort of agreements with your customers or terms that you set forth. You're also gonna wanna have operational docs like your org chart, employment agreements, like I mentioned, SOPs. Oh my god, SOPs. Just existence of SOPs will help increase your value, I promise. And then you wanna lay out, your tech stack, your systems, right? How many systems you use, where they are, and this is key, your cybersecurity compliance, IT compliance, you're gonna wanna have all of these things buttoned up. Now, I'm not saying that as soon as someone says, "I might wanna buy your business," you turn all this over to them. You need to get an NDA, by the way, and at least it should be in the LOI-ish, alphabet soup over here. Getting an NDA or non-disclosure agreement would mean that there's a confidentiality to what you're sharing and that they won't use that for evil, basically. So all of this is just to tell you, you need to avoid red flags that kill deals when it comes to the sales process, and you need to be able to think proactively and think, "Oh, I don't have these things that Shannon's describing. I should go make these." Yes, you should. And it's never too early to start. And a couple of things that really kill these deals. One is commingling your personal and business expenses. I'll sing that till the cows come home. I'm not kidding. It was a deal breaker because if you commingle all this stuff over and over again, then you're eroding trust with your potential buyer, potential partner, whatever it is, because they won't know what's really personal and what's really business. If you can't verify your revenue or cash flow with anything substantial, like you can't prove that this is from real customers, okay? Maybe you have legal settlements or IP disputes. There might be something out there in the wind they get wind of that maybe we're not going to be able to see through the deal because they don't trust you due to this, due to some other pending issues going on. And then finally, employee classification. This is big. So if you're paying all of your employees as 1099s, but like they're really employees, W-2s, but you're trying to avoid the payroll taxes, that's another no-no because if they inherit or they buy this business, then they're going to be stuck with the bill and the accusations that they're misclassifying people and they're going to get hit with all those penalties. So ultimately what your buyer's trying to do is mitigate risk in the process of making the purchase. So how can you mitigate risks for them? By setting yourself up like this. This is really what we're going for. You wanna have all of this really coordinated. If you have the personnel, I would highly recommend you charge somebody with a readiness effort, like an initiative, and say, "I want you to go scavenger hunt all this stuff that Shannon just said." And I can even, give you a list. I think the show notes will capture this really well, but you can take all of these different items, write them down. Heck, you can ChatGPT this and say, "Hey, what do I need for a due diligence checklist or a business sale?" And you can even put in your industry and you can talk about, "Hey, what should I have ready to go?" You could then make this list, deploy somebody in your company and say, "I want you to make a readiness booklet in a sense of, do we have everything on here? And then the stuff that we don't have, we need a plan to go get it. And who is that person that can do that for us?" And there you go. There's your plan. I love technology. I think it's great. So make sure that you're really clear on your strategy. You're really clear on what you would do if an offer presented itself, because I guarantee you, one day you will probably get presented with an offer or at least a question as to whether or not you'd explore one. It might catch you off guard, but I want you to not even hesitate that if you would think about doing it, that the stress of preparing for it wouldn't even come into play because you're going to be fully ready with all this type of stuff.
As you think about growing and scaling your business, it's important to focus on how your operating costs align with your profit and personal goals. Are you allocating your resources wisely? Are your expenses supporting growth, or are they holding you back? Building a sustainable and profitable business takes intentional budgeting and regular assessments of where your money's actually going. Now, with a power session, you can get personalized strategies to help your businesses thrive. Check out the show notes for more information on power sessions and how we can work with you to create the profit plan your business needs for a successful 2025.